with Lusk Mortgage Group. Welcome to 120 Days Home Buying Online Edition. Today is week 3. So we're talking about some really cool stuff today, some really important stuff when you go out to start looking at houses. You want to know what all you're paying as far as a monthly payment goes. So today we're going to cover what all's involved in your monthly payment. So that way you can start planning for what type of home you should be looking to purchase based off that monthly payment. It's really important when you go to get pre-approved that you talk to your loan originator about what all's included in your payment and what your total monthly payment is based off the price point that you've been pre-approved for, as it will vary. A $250,000 house is going to have a far different payment than a $150,000 house. So let's kind of dive into exactly what's included in a monthly payment. So first and foremost, you have your principal balance, right? So your principal is just principal. Then we have what's called interest. So once you've closed on a home, you've got an interest rate that's been paired with that. So that interest rate is factored into what your monthly payment is, which is where we get principal and interest. So that's what you're going to pay if you have a fixed loan. Say you have a fixed 30-year mortgage, that principal and interest payment is always going to be the same. Same if you have any fixed product. Now there are what's called ARMs, and we'll talk about that later on as well. But just wanted to mention that if you do have an ARM, your principal and interest payment will change over time. But principal and interest is just going to be the total amount that you're loaning plus the interest that you're being charged for the loan, and that will be part of your monthly payment. Now after that, you're going to see that you're paying, if you're elected to have an escrow account, which we'll talk about the importance of an escrow account as well, but just by standard, most first-time home buyers and second-time buyers are opting for an escrow account. So this is what pays your taxes and your insurance for you on a monthly basis, so it can be dispersed for you on an annual basis. Now, homeowners insurance is what's paid to cover the home in case of a fire or hail damage or something of that effect. That way your home's covered and has the ability to be rebuilt if there is something that occurs. Secondary to that, you're going to see property insurance. So every county is going to have a different, what we call mill levy, that determines what the property taxes are on a property. But if you're electing for an escrow account, that property insurance monthly amount broken out over a 12-month period is going to be included in that payment as well. So that way that can be dispersed for you along with your insurance on an annual basis when they come due. So escrow accounts are kind of that fun little checking account off to the side of your mortgage that pays that taxes and insurance for you on an annual basis. So you're paying into that account every month, so that way that can be dispersed. So the third thing, if you're not putting 20% down, or if you're in a loan product like FHA, you're going to have mortgage insurance. So mortgage insurance is what's paid to the lender in case of liability reasons, right? If something like we talked about with hail damage or fire or something like that's occurred, the lender wants to make sure that they're able to recoup the cost of the loan. So that's what the mortgage insurance does, is it protects the lender in case of default or disaster. Okay, so you're going to see that within your monthly payment as well. Now, all of those things combined is what's going to be on your mortgage statement once you close on a home, and that's going to be that final number that you're going to be paying on a monthly basis. But all of those items are going to be included in that monthly payment if you've opted for an escrow account. Okay, so when we come down to principal and interest, we talk about, well, how do we get that number? Well, what we look at by standard, let's say we're doing a 30-year mortgage, we're going to take that amount that you opted to loan plus the interest rate, and we're going to amortize that over a 30-year time period. And that's what breaks down what that monthly payment amount is going to be and how much goes to principal and interest every month to pay that loan off. When we come to the time where you're looking to refinance a loan or you're looking to sell that home, you do what's called a payoff. Okay, so a payoff is going to be a completely different amount. Now, your payoff at the end of a note, we'll see that on an amortization schedule when you go to close on a home, and you're more than welcome to play with those kinds of things online as well. And I'll tell you what you've paid over the course of a 30-year period for that home. But it's fairly common that folks are staying in their first home for 5 to 6 years. Kind of seems to be the standard that we're seeing nowadays. So if you were to go and sell that home maybe 5 or 6 years from now, you would order what's called a payoff. So that's going to show you what you owe in principal as of right now, plus the interest to year to date. Right? So you're going to pay off that amount. You're not going to pay off all of the interest for the next 25 years after that 5-year time period. So there is that cutoff. You're not paying the interest for the full term if you decide to sell that home or to refinance that home earlier than the end date of the loan. All right. So if you all have any questions, feel free to private message us or message down below here. Be happy to get back to you, but we'll catch you next time. Thanks so much for tuning in.